What if your investments could actually pay your bills this month? Not someday in the future, but right now. Imagine your phone bill, your internet, or even your groceries being covered automatically by your portfolio every single month. Today, I'm going to show you how to build monthly cash flow using dividend-paying ETFs that are designed to pay you, not just grow on a screen. And I'll show you exactly how much you'd need to invest to cover one small expense, like $100 a month. But before we get into the numbers, here's something important to remember. This is not about putting all your money into high-yield ETFs. It's not about chasing huge returns or trying to get rich quick. It's about taking a small portion of your portfolio and turning it into something that gives you tangible results you can actually feel. Because financial freedom isn't just a number on a spreadsheet. It's about feeling a little lighter, one bill at a time. This is expense-free fire, where we build freedom one bill at a time. If you've been investing long-term, you probably know the feeling. Your portfolio is there. Sometimes the numbers go up, sometimes they drop, but it often feels like you're just waiting. Meanwhile, life keeps showing up. The rent is due, the phone bill arrives, groceries still need to be bought. This is where many investors lose motivation. You're investing for the future, but the results feel invisible. That's why adding some cash flow-focused assets to your portfolio, even just a small part, can make a big difference. Because when your investments cover even one small bill each month, like your phone plan or your streaming services, it takes some weight off your shoulders. It gives you motivation to stay invested. You're not just waiting anymore. You're participating. Now, some people ask, why not just keep that cash sitting in the bank? Why not park it in a savings account and play it safe? But the truth is, that cash is probably earning close to nothing. Maybe 0.5% if you're lucky. Meanwhile, inflation is eating away at its value every single day. What if you could take just a portion of that idle cash and put it to work, earning monthly income that helps cover your fixed expenses? Not your entire portfolio, not your emergency fund, but just enough to start seeing real results. This is where monthly dividend ETFs come in. So, how do these funds actually generate cash flow? Many of these ETFs use a strategy called covered call writing. It works like this. The fund buys stocks like the NASDAQ 100, the S&P 500, or sometimes even a single stock like Coinbase or NVIDIA. Then it sells options on those stocks. These are called covered calls. The fund collects option premiums from those calls, and that money becomes the income they pay out to investors every single month. Some ETFs also hold preferred stocks or corporate bonds that pay steady interest. The key difference between these funds and your typical growth stock ETF is that these funds prioritize income first. They are built to pay you regularly. Let's break these funds down by categories so you know exactly what they are. Starting with the ultra yield category. These ETFs are designed to generate very high monthly payouts by selling options on a single stock. The two biggest names here are CONI, the YieldMax Coinbase Option Income Strategy ETF. This fund earns income by selling call options on Coinbase stock. And NVDY, the YieldMax NVIDIA Option Income Strategy ETF. This one sells options on NVIDIA stock. Because these stocks are highly volatile, the option premiums are large. Right now, these funds yield about 15 to 18% per month. To generate $100 per month with CONI, you'd need about $670 invested. For NVDY, around $860. The benefit is high cash flow. There are risks, of course, especially since these funds depend on the performance of one stock. That's why many investors use these ultra-yield ETFs for just a small portion of their income portfolio. Next, the high-yield category, which spreads risk across many stocks instead of just one. The first here is QYLD, the Global X NASDAQ 100 Covered Call ETF. It holds the 100 largest non-financial companies listed on the NASDAQ, including names like Apple, Microsoft, and Amazon, and sells call options on this index. Next is RYLD, the Global X Russell 2000 Covered Call ETF. This fund holds 2,000 small-cap companies and also sells covered calls for income. Then there's JEPI, the JP Morgan Equity Premium Income ETF. JEPI invests in large-cap U.S. companies, mostly from the S&P 500, and uses a mix of stock selection and covered call strategies. Lastly in this group is JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. JEPQ focuses on Nasdaq stocks, but like JEPI, it combines covered calls with actively selected growth companies. These high-yield ETFs generally pay around 10 to 12% annually, distributed monthly, to generate $100 per month. With QYLD or RYLD, you'd need about $10,000 invested. With GP or GPQ, closer to $11,000 to $12,000 invested. These funds don't rely on just one stock. They spread their holdings across hundreds of companies, providing steady income and some potential for growth depending on market conditions. Now, if your focus is on more stability and less volatility, here are some ETFs that take a different approach. SPHD is the Invesco S&P 500 High Dividend Low Volatility ETF. It selects 50 stocks from the S&P 500 that have both high dividends and low price volatility. PFFD is the Global ex-US Preferred ETF. It invests in preferred shares, which are a type of stock that pays fixed dividends, similar to bonds. There are also bond ETFs like VCLT, the Vanguard Long-Term Corporate Bond ETF, and LQD, the iShares Investment Grade Corporate Bond ETF. Both hold corporate bonds and pay interest monthly. These ETFs yield between 3 and 6% annually. To generate $100 per month, SPHD would require about $30,000 invested. PFFD would require about $20,000. These funds may not yield as much as the high-yield covered call ETFs, but they can add a layer of stability to your cash flow plan. So, how do you put all of this together? Here's one example of how you might mix these ETFs, depending on your risk comfort. The aggressive portfolio focuses on maximizing cash flow. It includes 50% in JEPI and JEPQ, 20% in QYLD or RYLD, 20% in CONI or NVDY, 10% in PFFD or SPHD. With this mix, you'd need about $7,000 to $8,500 invested to generate $100 per month. The balanced portfolio provides a good mix of cash flow and risk control. 40% in JEPI and JEPQ, 20% in QYLD or RYLD, 10% in CONI or NVDY, 30% in PFFD or SPHD. With this balanced mix, the amount needed for $100 per month is about $9,000 to $11,000 total. The conservative portfolio focuses on more stability with lower yields. 50% in SPHD and PFFD, 40% in JEPI and JEPQ, 10% in QYLD or RYLD. To reach $100 per month with this mix, you'd need about $15,000 to $18,000 invested. You can adjust these percentages based on your personal goals and your comfort level. The important thing is, you don't need to put all your assets into these funds. Taking just a portion of your portfolio and putting it toward income can make a real difference. Because when one of your bills is covered every month by your investments, it feels real. It's not just numbers on a screen, it's your phone bill, it's your groceries. It's one less thing to worry about. That's why I believe in balancing long-term growth investing with cash flow strategies like these. Not to replace your growth plan, but to support your motivation, your mental health, and your financial momentum. If this video helped you rethink your investing strategy, hit like, subscribe, and ring the bell for more expense-free FIRE ideas. And let me know in the comments, would you lean toward aggressive cash flow, a balanced approach, or more stability? This is Expense-Free FIRE, where we stop waiting and start covering life one bill at a time. Thanks for listening, and I'll see you in the next one.